Successful investing does not require stratospheric IQ, insider information, or luck for that matter. Instead, what's needed is a sound intellectual framework for making decisions, combined with an ability to keep emotions from ruining it. In The Intelligent Investor, Benjamin Graham presents such a framework together with logic that will help to keep your emotions under control. Arguably, his investing strategy has been one of the most successful ones during the last 100 years. The impressive records, not just of Graham himself, but also of numerous of his disciples, are impossible to ignore. Among these, the brightest shining star is Warren Buffett, who, at the time of this video making, is the third wealthiest man in the world. Warren Buffett refers to this book as by far the best book on investing ever written. In this video, I will present the, in my opinion, greatest important point from the book. Number 1, the companies should be large, which Graham defined as generating more than $100 million in yearly sales. After inflation, this equals approximately to $700 million in today's value. 2. Look for companies that are conservatively financed. Such a company has a so-called current ratio of at least 200%. This means that its current assets are at least twice as big as its current liabilities. 3. Dividends should have been paid to shareholders for at least the last 20 years. 4. No earnings deficit in the last 10 years. 5. At least 33% growth in earnings during the last 10 years. This translates to a conservative growth of 2.9% annually. 6. Don't overpay for assets. The price of the stock should not be higher than 1.5 times its net asset value. The net asset value can be calculated by subtracting the company's liabilities from its assets. 7. Don't overpay for earnings, either. Don't let the P/E ratio be higher than 15 when using the last 12-month earnings. An alternative today is to invest in an index